This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. As much as I'd like to tell you that this week's episode has a bunch of answers for how to manage risk amidst the latest geopolitical crisis, that's simply not possible. In fact, with the fog of war still very thick, it strikes me as better to wait a bit and see how the coming days unfold, and then we'll make an attempt in next week's episode to answer some of those questions with Elliot Hentov. For this week, I wanted to focus on the key themes that were driving markets before the weekend. The significant rotation within stocks from software to hardware, from cyclicals to defensives, all of which were part of the greater scrutiny being given to what had become very crowded and very expensive positions in themes related to artificial intelligence, as well as in corners of private asset markets. To do all of this, I'm joined by Kayla Sater, a senior strategist and something of a jack of all trades on our team in Boston. Kayla has previously covered equity markets. She's now focusing a little bit more on rates and credit and FX markets. She always has a keen eye on our indicators of investor behavior across all of these markets. Recently, she and Marvin Lowe, another frequent guest on the podcast, just collaborated and published a very high-level paper on how to think about AI's disruptive potential and what the effects in public and private markets have been and will likely be.
How are ya?
Good. And you?
Oh, hanging in there.
Hanging in there. How's the snow?
Basically, I can only get one car out of my driveway at the moment,
Wow.
which is not a terrible problem.
Means you have two
It,
cars.
I know, right? Exactly. Read between the lines.
Kayla, it's great to have you back on Street Signals. Thank you so much for rejoining the podcast this week.
Thanks so much for having me. I'm excited to be here.
Yeah, definitely. I want to talk about a paper that you have just put out with Marvin Lowe, came out last week, called AI as a Disruptor or Destructor. And we're going to try and answer that question. Well, actually, is it a question or is it just a statement that is a disruptor and destructor? I don't know.
That's a good point. I think it's important to say that we don't know, right?
Yeah.
Like, we don't know what the world of AI is going to look like in 10 years. If the change is as large as I think people expect it to be, this change is likely going to be structural and be slow moving. So I think anyone who says the world is going to look like X, they have a lot of confidence in things that don't have a lot of data to support them just yet.
Yeah, exactly. And we're going to try and answer as many elements of the questions around this as we can. But it is a huge question. It's one that obviously doesn't have a correct answer because, as you say, there's so little data on it so far. And we're going to tackle this in a few different ways. It's a markets podcast, so I wanted to start with what AI has meant for public markets. We, of course, have to talk about private markets because that's where a lot of the funding for data centers and hyperscalers is now coming from. Hopefully, we'll get some time to talk about what it means for public policy. But before we go any further, let's start with the impact that AI is having and the changing perceptions of AI in public markets. And especially, I think it's really the hyperscalers that we want to talk about and the shifting attitudes towards CapEx spend. Last year, it seems like these companies were being rewarded for ambitious CapEx plans, and the bigger they were, the better. And now it seems like the opposite is the case. What has changed in your view and why?
Absolutely. We have seen this shift in how markets perceive CapEx and how markets perceive AI more generally, especially because one thing we've been able to do is we can track the intensity of reporting on AI. What we found is that as intensity of reporting on AI increases, so does volatility. And that's a sign, I think, that as AI has become more important to public markets, investors are questioning, as they rightfully should, how good is this or is this actually a bad thing? And so I think some of this is a sign that investors are being pragmatic. Now, in terms of the CapEx, though, I think there's some things that make 2026 different than we've seen in the past, especially with these large hyperscalers. One is just the size of issuance. So, CapEx issuance is expected to increase about 60% to about 650 billion for, the big players like Google, Meta, Amazon, Microsoft. So that's a huge increase. Thinking through what that act like what does 650 billion actually mean? Because I think these numbers kind of get thrown around and you hear B's and T's and trillions and billions, not really think through what that means. So 650 billion is bigger than 487 other companies in the S&P 500's market cap. There are only 13 companies in the S&P 500 that have a larger market cap than what these other companies are spending on CapEx. Another way to think about that is that's about the annual budget of Argentina. So, you know, a decent G20 size market
Right.
or country rather. So it's huge. Also, what has shifted on the CapEx side of things is that this is starting to be funded with debt issuance. So traditionally, what has made tech so attractive is that there's like very low debt issuance. I was going to say there's very low leverage risk, and I still think that's the case. But the fact that debt is involved here is something new. So when we think about investment grade issuance, in 2020, communications and tech made up about less than 25% of overall issuance. Fast forward to today, and that's almost 50%. And so I think a lot of that is what has caught the market's attention. Now, I think it's important too to take a step back and say, why is this happening? Is this just because it's AI hype? Or is there something in the background that has made this very fortuitous? And I think one thing that isn't getting a lot of coverage that should is that One Big Beautiful Bill Act did encourage a lot of investment in three big ways. One is you have the restoration of immediate expensing for domestic R&D, which the Mag 7 account for about 50% of the S&P R&D spend. So they're incentivized. Another thing is changes to interest expense deductions. The cap has been moved from EBIT to EBITDA, so you are allowed to deduct more interest expense. And then finally, you also have 100% bonus depreciation for assets with a useful life of 20 years or less. And so, this isn't the main driver, but I do think that's important to keep in mind. This overall environment is very supportive of this overall CapEx spend. And that's one reason why we see this coming to fruition in 2026.
And on the credit side, and again, sticking with some of the publicly observable markets, whether it's CDS or just the corporate bonds that are out there. And again, as you say, up until recently, this wasn't really a debt financed market. It's increasingly so. We'll talk a little bit more about the private side of this in a moment. But when it comes to the public side and some of the disruption we've seen, you write in the paper about how this has been, in your guys' view, a little bit more idiosyncratic and how it is not necessarily a systemic problem yet. Can you talk about what makes it that way, and also what we should maybe look out for to see whether or not that changes and maybe it does become something that's a little bit more meaningful across the market?
That's the big concern right now is this going to metastasize into something that's much more widespread? I think on the credit side of things, we have seen default risks rise, not just for software, but across the overall marketplace. With that said, though, overall default risk is still quite low for software and for the rest of the market. I also think, looking through what the price of credit default swaps are, they're still quite low. We're not seeing huge signs of risk. And then, when we think also through our proprietary data and our real money data, where we see, are investors selling everything or are they just selling software? Really, what we see is two things. One, the underweight in software is exceptional, and what's interesting is we're not seeing that feed into other parts of the AI trade. We have actually seen year to date exposure to semis and tech hardware increase. So real money are still doubling down on this AI trade. Additionally, we're not seeing signs of huge outflows or readjustments in other parts of the market. And so, from an institutional real money perspective, it looks like this is still quite unique. Now, what do we look for outside of our proprietary data, or what are we looking for that would signal that things are getting materially worse? I would say we're always keeping an eye on liquidity. One thing that Marvin and I have talked about is, credit is the lifeblood of the economy, but the platelets is liquidity. And so if you start to see liquidity deteriorate, you will start to see or could start to see, a credit crunch. And if we continue to see credit flowing through, if we continue to see liquidity look okay, that's a good sign. And so, something to ask then is, okay, liquidity, what do you mean by that? Like, what do I actually look for to measure liquidity? There's a multitude of ways to do that, but you could look at things like overall reserves to GDP ratios. You could look at commercial paper versus treasuries. You could look at SOFR versus IRB. And the reason why I'm saying all of these things is because liquidity impacts so many different parts of the market. It's kind of this plumbing that impacts everyone. And it impacts everyone potentially a little differently. So we try to look at multiple kinds of plumbing, multiple parts of the market to get a sense of, is this concern spreading? And so far, liquidity markets look to be okay. They look to be still constructive.
That strikes me as being quite positive in terms of the rollover risk that a lot of these companies might face. But what about the fundamentals themselves? I'm thinking here, their balance sheets, coverage ratios, anything that stands out there that gives you some comfort, that makes you a little bit more relaxed that the underlying credit story is still okay, even if there's a bit more leverage, something that allows for these companies to function. Even let's say if, it's funny, we haven't even talked about the fact that we're recording this on the Monday after a huge bombing of Iran by Israel in the US. And, the market fallout from that has been so far pretty limited in equities and in credit markets as well. Assuming that stays the case, and this isn't a broad based case of risk aversion, what credit fundamentals really stand out to you that keep you relaxed about these companies?
This is important to talk about, especially because there is such a difference between small cap software companies or mid cap software companies and large cap software companies. And so when it comes to these big companies, when I look at their balance sheets and when I look at expectations moving forward, there still is quite low leverage risk and they still are very high quality. So usually when we look at quality, we think things like net debt to EBITDA versus return on equity. And a lot of these companies still have very high quality metrics. For example, when we look at that leverage risk, right? 2026 net EBITDA for Microsoft, Meta, and Google are all expected to still be negative, which is a good sign. They still have very strong earnings and very low leverage risk. When we look at Amazon, that it is a positive number, but it's still expected to decrease year-over-year, and it's still below 1. That's amazing. So there still are signs that it's not so much a leverage story, it's not so much a credit story when it comes to the large cap AI hyperscalers and the large cap AI story. Now, I think it's important to certainly still keep an eye on revenues. I think that's one thing that the market gets concerned about is as soon as revenues decrease for these companies that are spending so much on CapEx, will that feed through into overall profitability concerns? And we still see very strong revenue numbers and revenue expectations for a lot of these companies. So that means a lot of the drawdown, especially in software, has been very multiple compression driven. It's not so much earnings driven. So if it does start to become earnings driven, then it switches from a valuation story and a multiple compression story to something a bit more serious where we're seeing fundamental shift. But so far, we haven't seen that.
Actually, that's exactly where I wanted to go next, is talking about this depositioning in software, and the price action in software has been obvious over not just the last couple of weeks, but the last couple of months. But you brought up the scale of the selling, and I think it's important to highlight this, and I'll definitely put a chart of this in the show notes, which is just that the underweight relative to benchmark that Real Money now hold in US software, which I'm guessing the case is global software as well, is on a magnitude of what we saw after the dot-com bubble burst. And so the natural question then is, assuming again, all of these other geopolitical strains remain hopefully quite limited, or at least the impact to these assets is quite limited, is this now the buying opportunity? Have we depositioned enough, and are the fundamentals strong enough to incentivize going back in? Again, all of the things equal, sentiment being, as positive as it has been, that maybe, and not deteriorating further as a result of other events.
I think it is, and because I see 2 things. One, in our real money flow data, we have started to see not only slowing selling, but last week we did see signs of buying. So that means that institutional investors think there could be a floor here. The second thing is that, today, Monday, after a huge geopolitical event, there are two sectors that opened higher in the S&P 500. One was energy, the second was software. So to me, that's a sign that even though there's all this geopolitical risk that's certainly driving the rest of the market, there are signs that we have reached somewhat of a floor. And so that's positive for the industry group.
Would you extend that optimism to some of the sectors or industries and industry groups that didn't get hit? And here I'm thinking about what you mentioned before, the rotation from software to tech hardware. And I'm especially asking this in light of the response, especially to NVIDIA's earnings last week, which were, by all accounts and by all metrics, stellar, and yet did not get a great market price reception insofar as expectations are still very, very high. And even though they beat, even though the outlook is great, it wasn't good enough. And I'm starting to then wonder if what has been a software problem becomes a hardware problem at some point. What gives you confidence that that's not the case, or do you have confidence that that's not the case?
I think the big question under here, and the one thing that markets can answer amongst all this AI uncertainty is what's in the price and is it worth it? And I think that really drives some of the reaction to Nvidia is there's questions around can they sustain this kind of growth? Will this become a point where it's just too good to be true? I mean, 73% year-over-year revenue growth Q4 that's expected to continue again in Q1 and Q2. Gross profit margins around 75%. Those are amazing numbers and well above, the average company by far. But positioning is already very overweight in the industry group generally. They do trade at a higher multiple. But with that said, multiples have come down quite a bit. We're going to see lots of questioning and lots of pushback, but it's still generally a buy the dip environment. And that's at least the message we're getting in our real money data. And that's why we continue to see increasing exposure. I think overall what this means is that you're likely to see continued volatility around the AI story, especially because the AI story isn't going away. And so you're going to continue to get this pushback and this thoughtful pushback. I think it's fair, especially given positioning is still quite concentrated.
Actually, that is, before we start to talk about private markets, that's one final question I wanted to ask you about publicly traded instruments and particularly the turbulence around them. I think it was the last time you were on, we spoke about our turbulence indices, and particularly we were talking about dispersion and correlation. And that has been a key feature of markets this year, where the index, again, up till now, has been fairly stable. But within it, there has been significant churn and high dispersion. And particularly back then, I think this was about a year ago, we spoke about this. Correlation surprise that we can capture within our turbulence indices was rising. How would you characterize it today? I know the overall aggregate of turbulence is rising, and it has been rising for some time, the last couple of weeks. How are correlations contributing to that?
We still see very high levels of unusualness in correlations and very high levels of volatility. I do think this reflects some of the situation where positioning is so concentrated. You shift in this environment where high beta is high quality. And that coupled with high levels of concentration or very high levels of positioning, I think it means that you start to see unusualness in these correlations and you see continued volatility until you see more signs and broadening out and not just flows but also in positioning. I mean the three biggest overweights still by far are tech hardware, semis, media and entertainment, which is AI 2.0. Until we actually see positions diversify sustainably, which is very hard in this environment because of the high quality factors of these parts of the market, you're probably going to see very unusual levels of correlation.
Well, let's move now to the private side of things, because of course, this is an sort of AI adjacency that has also gotten damaged and has been part of this churn. But, the private asset issuers and asset managers, the names of which will be familiar to anyone who is listening to this, who reads the FT or the Wall Street Journal, they've all experienced some pretty significant drawdowns. And the reasons for it are what we're talking about. I think some of the questions that are being asked about AI and these software companies and CapEx. But I think there's also a growing, whether it's skepticism or a show me the money moment, maybe, for private assets more broadly. How are you thinking about this in these companies in particular, and whether it is a pivotal moment for them or not when it comes to the appeal of private assets?
I think private equity and private assets are getting a lot more attention, especially because there are structural shifts around who can invest. For example, last year we had President Trump saying, private assets can start to be included in 401ks. And so there are, I think, structural topics or structural events that are happening that put general interest into private assets more than they have been in the past. I don't think the degree of intrigue would be the same if AI exposure were not so high. I think the main driver here is that AI exposure is concentrated in multiple parts of the market, and investors want to understand what their actual AI exposure is. Because when we look at default risk for some of these parts of the market and some of these companies, it has increased, and in the past, it increased when leverage risk increased. And it's not so much to leverage risk is not the same today as it was, in 2022 or 2023 for a handful of these firms. There are exceptions, but a lot of the big ones have decreased their leverage risk over the last 3 years. And so to me, what that says is that it's not necessarily a credit event, it's the stubbornness of this AI trade or this AI discussion that can be an issue. That if this AI fear does not go away, that fear can lead to momentum. And we have certainly seen price reaction. But I think when we look at balance sheet risk and credit risk, it actually for some of these firms has improved, since 2022, 2023. And so I think that's a good sign.
It's interesting, and you brought up something I wanted to follow up on in terms of the broadening of the actual asset owner base. Because typically you think about the asset owners who are invested in private markets, and the classic story are longer term pensions who, especially during the era of very low rates, were fed up with that and needed some sort of return and were willing to live with maybe a lack of transparency. But if we're talking about a retail investor base that is now potentially getting greater access to these assets, how much can they in the future potentially contribute to these negative feedback loops when sentiment turns, if retail start to pull money and funds maybe start to get gated, and that then starts to create a downward spiral? Does that diversification of the asset owner base create potential seeds of systemic worry, or does it actually diversify it to a point at which there are still deep pockets and there are asset owners who are not going to be shaken out of this asset class?
I think the bigger story is, does private equity tie back to liquidity because they've been borrowing from traditional banks? I think that is a really big driver of some of this concern. So, for example, when we look at balance sheet data or we look at data from the Fed, so the H8 data, what we can see is that banks' exposure to non-financial deposit or sorry, non-depository financial institutions has more than doubled over the last 5 years. We've seen loan book exposure to that group grow from 5% to about 11%. So that's aggregate banks in the US. Even smaller banks, that number's much lower. It's about 4% today, but it's up from 1%. And so I think that is less so who is investing in this. I think some of the bigger story is how exposed is the financial market or the drivers of the financial market and liquidity and credit. How tied are they to these private equity firms? And so, I think that is a really important systemic shift that has occurred over the last couple of years.
Well, it's good to hear that the asset markets might weather the storm, but I wanted to close with a section on fundamentals in the economy and what it might mean for monetary policy, all of this explosion of interest in artificial intelligence. And it would be remiss to not mention the paper produced last week by Citrini that's been blamed for all sorts of things, from the sell-off we saw last week in equities at the beginning of the week, which is, someone pointed out today, orders of magnitude greater than a huge bombing of Iran taking place over the weekend in terms of the effect it's had on equity markets, as in today, there's almost been none. But that was seen as a very kind of seminal moment in the discussion of what AI might mean for labor markets. Software companies had the fallout as a consequence of this. You had everything from Uber to Amex getting hit as a result of this increasing fear, I suppose, that labor displacement will be so high as a consequence of artificial intelligence. I mean, what points of agreement or maybe what pushbacks do you have to the views and the scenario that was painted of a potentially stagnant economy with high unemployment, all due to this wonderful technology that we'll all have access to?
What we see in the labor market so far and what we see in overall trends, even like this AI story isn't new, right? It has been here and developing for years. And when we look at the labor market right now, it's still okay. For example, you have a story where there are concerns that AI is taking the jobs of recent graduates. So when we look at unemployment levels for recent graduates or for folks 20 to 24 years old, unemployment today is actually lower than the average from 2000 to today. I think sometimes what's getting lost in the noise is that the labor market has been through a lot over the last couple of years. We recently got through a Fed hiking cycle. There's been major supply shifts. Uncertainty is incredibly high given tariffs and now a war or geopolitical risk. And I think it's really hard to disentangle those risks from this AI story. And again, this AI story does feed uncertainty. But I think when we look at wage growth, which is still very strong across all sectors, when we look at unemployment levels, what we see in the data right now is not saying AI is taking jobs. I mean, even when you look at discussion of layoffs and earnings is still quite low. It was actually much higher in 2022, 2023 when the Fed was hiking rates. I think when you put that in context with the degree of AI discussion, it's not leading to conclusive evidence that AI is taking away so many jobs. That's not to say it couldn't or it won't. I think that's a huge question, but I also think it's fair to say that that's certainly not a base case because there's not enough evidence to support that yet.
Do you have any thoughts on where it might show up? What industries would you keep an eye on? You mentioned some of the demographic cuts that still look pretty okay-ish, at least, that you might have expected to be affected by this at this point. But what industries are you keeping an eye on, and what sort of trends there are you seeing that, for better or worse, I guess, that give you comfort or give you worry about potential labor displacement?
I think it depends in terms of use case. So, certainly, there's been discussion of things from white collar jobs or anyone in an office. And I think that's why you have this entry level discussion where if you could have an intern do the same thing AI could do, why not just have AI do it? And so a lot of that feeds through to traditional white collar office jobs. So keeping an eye on that, sure. But I also think all companies are talking about AI to some degree. When we look at the breadth of conversations in earnings calls around AI, the breadth has increased. Every sector is talking about AI. And so I think that really feeds through into why the market and people are questioning, is AI going to take my job one day? Because so many different kinds of companies are talking about AI. With that said, though, it hasn't shown up in data to say AI discussion is necessarily correlated with layoffs.
Yeah. I mean, it's showing up in policy discussions for sure. And look, there's no right answer to the question that I'm about to ask you. But when it comes to a central bank and what they're supposed to make of this, you have on the one hand the notion of maybe some labor market disruption that we haven't really seen yet, but is always looming and people are fearful of it. That would suggest the ability of policymakers to ease policy quite a lot because it means your neutral rate is potentially lower as a result of just like hysteresis in the labor market and more permanent unemployment, and you need to stay easy for longer and get rates below neutral quickly. But then you have the productivity argument that ultimately argues that neutral rates are perhaps higher than where they are, and it sort of flies in the face somewhat of, I think, the new Fed chair's approach to, a productivity-driven argument to ease policy further. Where do you kind of fall out on these questions of where neutral is? How much is he going to actually be able to ease, in your view, given, as you say, we haven't really seen the disruptive, displacing effects of AI coming through? We haven't really seen the productivity effects either. So what does it allow him to do, and where is neutral for him?
I think the most important thing to look at in this conversation is inflation expectations. Because if inflation expectations are high during a period when the Fed has not been at target for years at this point, it's going to be hard to get ahead of any sort of theories around potential labor market displacements or productivity adjusting where actual neutral rate is. Because if inflation expectations are rising, that means Fed credibility could be impacted. And if Fed credibility is impacted, that would become the Fed's number one concern. For example, in the short term, we've seen this huge move in treasuries, and real yields have really fallen. Simultaneously, though, 2-year break evens are up something like 60 basis points year to date. And so I think as we start to get this transition to a new chairman, that is going to be front and center because ultimately, if we lose faith that the Fed can get to 2% inflation, we have an entirely different monetary regime.
Yeah, it's an interesting point to bring up. I was just typing on my Bloomberg, the ticker for 2-year inflation expectations, absolutely right. Looking a lot stickier. Long run inflation expectations outside of today, which we've had a pretty big move in rates all around, but even taking that into account, 5-year forward inflation expectations are still pretty well contained. So it seems like so far so good. I mean, actually, as a final question, what is driving that stickiness in front end expectation, do you think? Is it just the fact that we've seen realized inflation running hot? Or is it something a little bit more worrisome that is pushing those expectations up?
I think it's services,
Right.
which is interesting because if I were to say inflation expectations in the short term were rising in the aftermath of the US, in or the US bombing Iran, you'd say, "Oh, it's probably just energy." But because that increase, majority of it started in January and has just continued to tick higher, I don't think it's just energy. And when we look at the most recent CPI print, Supercore was still very hot. It was the hottest Supercore print in a year. So, and most of that, that's services. We've seen the Fed really struggle with the services component. And so that's why I think, it's not all doom and gloom, but really it's just saying we're not out of the woods yet.
What is it? No cuts, one cut, two cuts, four cuts. Where do you stand as a final rapid fire question?
I think the data right now would say no cuts,
Yeah.
but I would not be surprised if there is one.
And that's it. Then they're done.
They're done.
Done. And we're done. Kayla, you have covered a comprehensive amount of information on a very complex topic. And we've managed to do it without wasting too much of your time. You certainly haven't wasted my time. This has been great to catch up. Thank you so much for joining us again.
Thanks, Tim. This was great.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. Informational purposes only. It is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.